Stocks climbed higher for a fourth day in a row on the Dow Jones and the S&P, showing some all-time closing highs again, but we failed to cross a significant threshold. So I'm going to highlight what that is today. Also, some other technical patterns that suggest, this near-term run might be short-lived. So I'm going to break all that down, what the expectations are, how to manage risk as the bullish trend continues to chug along and stick around longer than you might expect it to. So how do we trade that? How do we manage the risk associated with that? And that's kind of one of the ways I focus on today's trade idea. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Tuesday, December the 12th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button down below the video there. Also, hit that thumbs up that's right next to it. That lets me know that you liked the video today. One click, easy way to give me some feedback there. Scroll down even further and comment on anything that stood out to you from today's video. Really appreciate the comments that have been coming in lately. A good batch of comments from last night's video, so keep those coming. Let me know what you're learning. In the video description, there's a bunch of links there. Subscribe to my daily email newsletter, Market Outlook newsletter, with the link that's in that description there below. Follow me on Twitter for more content in addition to these videos throughout the day. You can like and retweet today's Market Outlook tweet from there. Also, join the Market Outlook community on Facebook with the link that you see at the top of the screen here. There's a bunch of about 700 plus other students like yourself that are involved in watching these videos. So join the community, share with each other what you're doing, what you're seeing, what you're liking, and be able to benefit from that strong community that we've had going now for quite some time. All right, well, let's take a look at the S&P 500 first then with the market forecast indicator. Another update, so 4 updates in a row now, and threatening up to close up above that long upper shadow there. We were up above it until a drop at the end of the day got us back down about 5 points below it. So, so we are going to push this, this intermediate high point because we're still in the intermediate move, right? So we're going to move that up. The 4-week range moves up a little bit. We talked about the possibility of that yesterday. This near-term run still rallying. Let's see, that's that one. Nope, it's actually 3 days now. 3 days that we've got the near-term line up above 50, which again is the blue line down here. Market sentiment strong, intermediate posture strong. So the posture is still bullish, still very strongly bullish, very mature, but it doesn't mean we have to go down. It just means, again, just to lower expectations. And, we talked about the volatility over here with multiple long upper shadows and a big long lower shadow. Now, the long lower shadow, remember, is not as bearish as the long upper shadows are. And the long upper shadows on the top won't be as long as the long lower shadows on the bottom because volatility is not as high over here. But you can see how still, we taught, that long upper shadow still acted as a resistance level because, again, we weren't able to close above it today. We'll see how that responds tomorrow. The near-term line is strongly up in that upper reversal zone, which again supports the bullish posture that we're going on 4 months now. We've seen in the last 52 weeks we saw a 4-month long intermediate run that lasted that turned into some bearishness with market sentiment up close to where we were at now. Market sentiment starting to roll down. You notice market sentiment didn't drop below 80. It took, let's see, 1, 2, almost 3 months before the market sentiment line got above 80 and then dropped below 80. We are now 1+ month going into the intermediate market sentiment line being above 80 and dropping back down eventually back below 80. So again, so I'm not looking for the market to drop today or tomorrow. What I am looking for is, kind of a slow grind in the upper half, again, of the 4-week range. And that's from the S&P. The Dow's going to look very similar. The Dow had the best performance today. Again, closing up with a new all-time high point here. Also not able yet to close above that 534 high, the long upper shadow high. So something to keep an eye on heading into tomorrow. The Nasdaq's not up, it's not forming a new high yet. little bit of a down day today as the near-term line comes down. Intermediate confirmation signal with the bullish posture on the intermediate line rising. Not strongly bullish yet, but at least it's rising. And then an oversold momentum line. That's, that can be considered a buy the dip opportunity, especially. Again, ideally, you'd like to see that near-term line also below 50. In this particular case, we've only got the near-term line, 4 days up above 50. So there's that possibility that we could buy this dip, move up a little bit above 6,900 like we're seeing on the other large cap indexes. And then finally, on the Russell 2000 here, worse than the others, forming a bearish high point. You can see this near-term line high compared to the last near-term high, so more bearish. So small cap still not participating. Again, another reason why not to be as bullish. So when I say not to be as bullish, again, it doesn't mean to not make any bullish trades. It just means to position size differently than what you normally do when you are more bullish. Position size differently. Don't make as many trades. Dial back the number of trades you make, because on any pullback, you want to take a look at your portfolio and say, okay, how many trades, if I got stopped out on all my bullish trades right now, how much would I lose? Total. That's my total portfolio risk. And so that number, as we get more and more mature, you want that number to get smaller and smaller. And the way you do that is you add balance to your portfolio. You don't have to be aggressively bearish, but you add some bearish trades in there. You add some neutral trades in there, and you start dialing it back so you're not so heavily one-sided in case of any pullback. And we talk about how the market doesn't tank from strong all-time highs, but it doesn't mean it can't, because anything can happen. We just know it hasn't in the past. But, there wasn't Bitcoin in the past. Things change, new things develop. So we have to keep an eye on those things. But we also have to base expectations on what's happened in the past, but be prepared for the unexpected using position sizing, stop losses, things like that. So here's the long-term view, and again, that's when I say we don't tank from all-time highs. I mean, we don't tank when the MACD is up this high. If you were to go all the way back as far as we can, and you take a look and and again, we'll just take a look because we're about as high as we've ever been. So let's go about this level. This is, where some of the high points are. And you notice, well, yes, we do run out of gas at these high points. We don't, here was one, 1998, the long-term capital management. That was probably the one major example of a tank from those all-time peaks. Again, excessive risk-taking there. Otherwise, we kind of gradually move to weakness across all these levels. And you can see in 2013-14 during QE3, we just kept moving higher with just brief touches of the 200-day moving average, if that. And we're seeing very similar things today, not with QE3, not with monetary accommodation, but expected fiscal accommodation. The market's kind of anticipating a lot of fiscal accommodation there, and that's why we're seeing such a bullish move in 2017 compared to what we've seen before. Really, the only precedent is 2013 and 14, where we had just insane amounts of fiscal accommodation. Sorry, monetary accommodation. So now looking at the 3 green arrow chart, we're still, we're even more setting up for a divergence here. The MACD, it's getting up there, not quite past that peak here, but close. We already are past the, closing high point here, and now, getting a higher intraday high than the previous intraday high point. And the stochastics is not even close to its high. So still that divergence. We are well far away from that 8-day moving average. So if I were to change the MACD down there, let's change that MACD to the how far up above the 8-day moving average we are. We'll take off its moving average. Well, no, we'll leave its moving average. Take off the histogram. All right. So again, that's how far up above the 8-day we are, and you can see a big diversion setting up there too. I mean, we were way up above it over there. Over here, we were well up above it, and then pull back down to it, bounce off of it, much lower high point than what we see. Much lower high point, but obviously much higher high point on the actual index. So some big divergences setting up here on these technical indicators that would suggest, I mean, again, bullish posture. So it doesn't mean that we have to like turn bearish. It just means dial back our exposure. Appropriate risk management. There's all sorts of things you can do in risk management. And the best times to use risk management is when the market is as boring as can be. Small ranges, small volatility, small volume, things like that. Because as things pick up, then, you know, protection gets more expensive. You've already lost some profits you're trying to protect, all those kinds of things. Things start to happen, it gets harder. So when the market's kind of like this, still bullish, then we start using appropriate risk management. But still trading the trend, because again, the biggest risk in a bull market or in a bullish trend is not trading with the trend. Same thing in the bearish market. You know, that's the biggest risk. So trading with the trend, but then doing so with managed expectations using, you know, these technical indicators, volatility index, PE ratio to give us our expectations. So here's today's move. You can see we're kind of gradually moving up here. Low of the day was early. The high of the day was not late. So that's a little different than the last couple of days. We finished at the high of the day the last couple of days. Not today. We finished down. In fact, the S&P came down back below last week's high point. We had closed up above the 4-week high point, but then came back down and are testing it for a support level. So pretty, you know, still a bullish candle, tempered a little bit because we didn't close at the end of the day, but still bullish nonetheless. If we were to take a look at, let's see, oh yeah, that's right, we can't do the volume there, 83 million for SPY. If I take a look at the range for SPX, you know, that's at 10 points was the range today. That's really, really low and very small. So, you know, that's, again, markets are getting, that's bullish. When the markets get boring, that's a bullish sign when you're bringing these down. Then when you look at the 83 million, we're still not bringing the volume down. So that's an issue. And then when you take a look at the volatility index actually rose today. And started to take off into the afternoon. Not significantly. I mean, it still would be an obviously lower high point, and we're not even above 10. But if you look at it on a relative basis here, then you can see, again, still extreme, just like the VIX, you know, still below 10, still below 80%, which is extremely low, but a big sharp move higher off of the open today, which is bullish, bullish for volatility. So again, you know, we talked about as this near-term rally started a couple days ago, not to expect the typical 7 to 12-day near-term run. You know, can we get up to new highs? Probably not, but if we do, it won't be very high. We know in this case we did get up to new all-time closing highs. Are we going to close above that long upper shadows, the big question mark? But you can see how some things are setting up for more, you know, for this near-term run to not last very long from a technical perspective, and start to, again, and they don't last very long as you get towards the end of these intermediate runs. You know, we're almost 4 months into an intermediate run. The typical run's 1 to 3 months, and typically when market sentiment is as high as it was when we started, we're more towards the 1 to 2 month range. So we've really overextended, and a lot of it's based on this expectation of fiscal policy helping the stock market, helping to push the sentiment higher and pushing stock markets higher. And you see economic indicators, a lot of them sentiment-based too, survey-based, are also showing some very strong numbers too, pushing stocks higher. Again, that's okay to ride the trend because the biggest risk is not riding the trend, but managing risk means riding it in a very appropriate way with managed expectations. All right, now let's talk about what's driving the price action today. And of course, daily reminder here to follow me on Twitter for more content in addition to these videos throughout the day. I changed some of the pictures, but the address is still the same, at David Settle 42. You can see the address up at the top. There'll be a follow button over here on the right, and a reminder too to remember to like and retweet the market outlook tweet day after day. It's always pinned to the top, so easy to find. The more you engage with this and any other tweet of mine, the more Twitter will keep pushing you my stuff instead of getting lost. You'll notice every time you pull up Twitter, the tweets that pull up first are from accounts that you engage with the most. So make sure you're liking and retweeting that, and you'll keep seeing the tweets I put out there throughout the day. One of the things I tweeted out today was, kind of again going with the theme of how bullish we are, how high we are right now. This is the 10-week moving average of this is an investor sentiment survey of how bullish we are. There's also bears and neutrals, but this is the bullish, and you can see how high it is on the 10-week average. It's pretty darn high. Now, the last time we were this high was coming off of so here's the recession of 2000, 2003. And then by 2005, we got up to this peak. And the market didn't peak until the end of 2007. So again, just because we are this high doesn't mean we're tanking tomorrow. But again, we had a good run to get up there, and the market still had pretty decent returns. Again, watch for the start to increase the volatility and the risk and the sector rotation and things like that come usually after big peaks like this. From a calendar standpoint, of course, everyone's looking ahead to tomorrow. We have a lot of red dots tomorrow, a lot of FOMC related. Press conference, dot plots, the rate hike announcement expected to come out. But you also have CPI and the petroleum report, whereas today we had PPI. And if you look at the PPI, which is the wholesale inflation, look at that big trend higher here. We're continuing to move up, move up, move up. So again, the election was back here in November 2016. We were at 1.5%. We're at 2.5%, 2.4% now. And you look at the wholesale rate, so the headline rate. This is the bar graph here is the core rate. The headline rate was about 1.25%. And now it's up to 3%, so more than doubling, way more than doubling. The headline rate is since the election. So, and you can see here, this is the PPI, this is the year-over-year rate, the headline rate again, and there's your, right about here, is your headline figure, and you can see how much we've rallied. In fact, coming off of 2015, when we were kind of, we're coming off of those, the QE3 ended right here, and then we had this kind of the stagnant 2015 where we didn't really go anywhere, and economic indicators were pretty bearish, prices dropped. I mean, look at that big rally in year-over-year growth rate since then. Quite the move. And the core rate almost got negative, and of course, big growth rates since the end of 2015, so the last 2 years. Big move in prices on the core rate as well. So inflation is starting to, even though it's not high, it's a lot higher than it was, and so that's going to put pressure on consumers as prices start to increase on some of these non-discretionary items that are in these indexes. We take a look at, okay, how's the Fed funds futures market reacting ahead of an expected announcement tomorrow. So this is for June, and of course right now we're at the 100 to 125. The odds of us not having a rate hike by June have gone to nothing. So we're going to get one, and we're going to get one tomorrow, and that's the purple line, is tomorrow's rate hike. Now, the odds of that being the only one between now and next June are down below 20%. So, but you can see it's rising compared to the odds that we'll get us 2 rate hikes. So the odds that we'll only get 1 rate hike is rising too. So the market's starting to price in this inevitability that we'll get a rate hike in December, get us up to this 125, 150 level. But you can see how the odds of having 1 rate hike in March are rising too, now up over 50%. So it looks like, whereas before we were kind of expecting 1 in December and then maybe 1 in June, now it's 1 in December, 1 in March, and none in June. Is kind of what the Fed funds futures is pricing. And again, very, very strong economic indicators, still looking very strong. And when you take a look at today's move, you say, okay, well, you take a look at the long-term bonds, and they're dropping again. Still small loss, and the dollar was up again, and with a small gain, and that puts pressure on gold, which had a small loss, rallied by the end of the day. But look at crude oil. Crude oil was the biggest loser. That's been the biggest mover. When you look at this little run that we've had, crude oil and emerging markets were the biggest winners. They pulled back the most today. You can see long-term bonds and gold have been the decliners, are still down, but you can see the gap is getting bigger and bigger between small cap stocks, which led this initial bounce, to now, having really in the last 4 days only less than a 0.5% gain, whereas large cap stocks are up 1.5%. So 3 times the return on large cap stocks versus small cap stocks during this 4-day streak that we've had on the S&P 500. So put some context into just how bullish we really are and the expectations of a short-term pullback and more volatility in this near-term line as we head towards the end of this intermediate run. Now, again, just because we're heading towards the end of the intermediate run doesn't mean that we're now going to start, a year-long bear market, right? We can pull back in the intermediate line, pull back below 50, and start a new one. In fact, as you see, something else I tweeted out, this idea that there's still a lot of life left in this bull market here. An article that I wanted to share with you, kind of going with what we talked about yesterday. The expectations for 2018 are still looking pretty good. So don't expect in an end of an intermediate run to start this, just drop off a cliff. No, we're just going to kind of go sideways for a while. Have some volatility, have some ups and downs, but it will set up for another intermediate run that will start probably sometime at the beginning of next year. Alright, so we'll take a look at the sector rotation during the same 4-day rally here. And remember, again, crude oil and emerging markets were the biggest winners from an asset class. Energy stocks and technology were your big winners from a sector rotation, healthcare coming in there. Healthcare and technology still leading the way higher on the upside. But look at utilities dropping, staples really lagging behind during this rise. In fact, it has a 0.75% drop, up a little bit today, but look at utilities with this expected rate hike, inflation rising, which pushes yields up. Look what happened to utilities there, which had a pretty decent run the last few days. That was up almost as much as the market, finishing every day with a gain. Not today. Utilities really dropping sharply today as a sign that again, with yields rising on a long-term basis here, kind of getting rid of that potential head and shoulders pattern that we've been looking at for a while. We've been looking at this head and shoulders pattern, looking for some kind of drop. Well, we haven't. We started to bounce back up again. If this continues higher, look for pressure in that utility sector. Alright, for the trade idea of the day, I want to look in that utility sector, and one of the stocks in that sector, you can see AEP here, has been on a bullish trend, been riding above its moving average this whole time. A lot of volatility here recently. Pretty decent moves coming up off of remember how the last few days the utility sector has been closing at its highs of the day. You can see coming up with these long lower shadows. Not today. Big drop. Dropping below the midpoint of this Bollinger Band, heading towards that lower Bollinger Band. The bands have tightened, so you expect an increase in this bandwidth. As you can see, it's very cyclical. Of course, any increase if we're pushing the lower end, then you would expect the increase in the band to come from a drop to the downside. If you take a look at the 3 green arrow chart here, we'll load up the 3 green arrows, and we have 3 red arrows. You can see where we try to push off. We had a red arrow back here. We tried to get a new set of 3 green arrows. We never really did before getting another red arrow on the stochastics and dropping below the midpoint of the chart. You can see today pretty decent volume. Doesn't have to be high, but average volume, and now coming below the moving average. So you can see it's a relatively bearish day. Not something we want to be too bearish with, right? Remember we talked about managing risks. This means putting a little bit of balance in there and being selective with what we do. So if I were to take a look and just sell, the options, the spreads are a little wide, especially on that $80 here. But if I were to look to sell that 77.5 for 75 cents, again 5-cent spread out of 80 cents within that 10% threshold, and buy the 80 for protection here, then you can see I can get about a 58-cent credit depending upon where we get filled in on a $2.50 wide spread. That ends up being a 30% return on risk, kind of the sweet spot there. If you take a look at it on the Analyze tab, you can see you got decent odds of success, and that break-even point is up above these highs. So as long as we hold these highs and stay down, then we're fine. We don't have, it doesn't have to drop to 70. It just has to stay below that break even. And you can see, as long as it does, you know, the number over here in the left, in that green box, you know, we're going to lose. You know, if we were to get above that break even, getting above those highs, we know, okay, we're not, the technical basis for being in the trade's not there anymore. So we'll take a small loss, and we take a look at that green line, because that's, you know, time decay will eventually move the purple line up. So as time passes, you know, that green line, look at the number over on the left, and you'll see it's in the $30 loss, the $60 loss. We're going for a $58 gain. So it's a pretty decent 1-to-1 reward to risk ratio with a decent odds of getting something, some kind of reward on this trade. And knowing that we don't want to take that 192 loss. So if it breaks above those highs, then we'll take that small loss. It's a much better loss compared to the gain than 192 bucks is compared to 58 bucks. You get that concept down, you know, high probability trade like this, you get the concept of taking small losses down when you're not, when the trade's not doing, when the basis for being in the trade's not there anymore, then you're set up for success trading these high probability strategies. If you're going to let it go, knowing that you had high odds, knowing that we can turn back down, and it turns into a $192 loss, then it's, I've seen it too much. I've talked to too many people. That's when you really start to struggle. That's when you question about whether you can do this or not. You've got to have now multiple max gains to break even from that maximum loss, and the odds of that aren't high. That's not 71% of getting a maximum gain. It's not a 71% chance of getting 3 maximum gains in a row. It's only a 71% chance of getting any profit once. So, you know, you start to multiply that together, then you can see the odds of getting a maximum gain, you can see, are actually about 66%, roughly, 67%. You multiply that a few times together, the odds of getting 3 in a row are not very high. In fact, here, I'll show you. If I were to pull out the calculator here, the odds of getting 1 maximum gain, 67%. So we'll put 0.67. The odds of getting 2 in a row are 45%. And so we need 3 just to offset that maximum loss. Actually, a little bit more than 3, but about 3 to get that, to offset that maximum loss. So I need 1 more. So the odds of getting 3 in a row are 30%. I need a little bit more than that. So it's actually going to be less just to break even. So again, your willingness to take a small loss will determine your success trading this kind of strategy. If you're taking big losses like that, then you're not going to have success, because the odds are not in your favor in that particular case. So to summarize, the market remains strongly bullish. We're in a strong bullish long-term trend. A little bit of volatility rising today, and some maturity in some of these technical patterns suggesting that to start expecting shorter near-term runs, including this one potentially. So that doesn't mean necessarily that we're starting a bear market. It just means that there's going to be some more ups and downs instead of just the ups. In particular, with that long upper shadow still holding, that high still holding. So again, the biggest risk is not trading the trend. Otherwise, there's still good, proper risk management that can help you ride the trend but manage those expectations. And today's trade idea is one way to do that. So again, thanks for watching tonight. Remember to subscribe, like, and comment on the YouTube channel down below. Also, remember to follow me on Twitter for more content, and to like and retweet tonight's Market Outlook tweet that I have pinned to the top of my timeline. And if you haven't done so already, remember to join our Market Outlook community on Facebook with the address down in the description below. Have a great evening, everybody. We'll see you all tomorrow.